Hello and Assalamu alaikum. I am Kashif Kamran, and the topic I am discussing today with you is auditing disclosures in financial statements. Now, this is a very important area where the students appearing for the AAA exams should have a very clear idea about the importance of disclosures in the financial statement and how basically the auditor audits the disclosure in the financial statement. I think a couple of months ago, the AAA examiner has already written an article on auditing disclosures in the financial statements, and the students can even explore that article for a better understanding of this subject matter. Let's start the journey. Now, when we look at the disclosures, we know disclosures are an integral part of the financial statements. Financial statements consist of disclosures which are normally referred as notes to the account. Auditor expresses an opinion on the financial statement as a whole, so need to carefully audit disclosures as well. So when we say the financial statement as a whole, so financial statement as a whole consists of the notes to the account, and the notes to the account are basically known as the disclosures in the financial statement. So auditor is responsible for the complete financial statement, which consists of the notes or the disclosures to the financial statements. So that means the auditor is responsible. Moving onwards, the types of disclosures you should be aware of. Now, obviously, when you look at the notes to the financial statement or you look at the disclosures in the financial statement, the financial statement consists of two types of disclosures. One referred as quantitative disclosures, which are voluminous. For example, the disclosure of IFRS 8, the segmental analysis, the organization presents their segmental results. So segmental results is part of a quantitative disclosure. Disaggregation and analysis of balances and transactions included in the financial statement. You must have seen in the notes to the financial statement the breakup of the sales or the breakup of the fixed assets or the breakup of the current liabilities or the breakup of the non-current liabilities or the breakup of the operating expenses. So these are all disaggregations and analysis of balances and transactions. So that is a very voluminous part, right, where the management gives the breakups of the numbers put in the balance sheet or put in the income statement, and also the segmental analysis as an example of a quantitative disclosure. The next is the qualitative disclosure, which is important. There are some disclosures which are not by numerical values. There are some disclosures which are important because they're qualitative for the shareholders of the company. Confirmation that the going concern assumption is appropriate is a very important qualitative disclosure. We know financial statements are prepared on a going concern basis. Any disclosure relating to going concern, even the material uncertainty relating to going concern, that is all a qualitative disclosure. The accounting policies, the management puts the accounting policies in the notes to the accounting in the notes to the financial statement. That is also a qualitative disclosure. And also the related party disclosures most of the time are qualitative, that you disclose the name and the relationship with the related party. So the name and the relationships with the related party, apart from many other things. So you can have a combination of a qualitative and a quantitative disclosure in related party even. So the auditor needs to understand that there are quantitative disclosures and qualitative disclosures within the financial statements. Now, what is basically the problem with disclosures when it comes to audit? What are basically the challenges with disclosures when it comes to audit, and how the auditor basically performs the audit of disclosures in the financial statement? We are very sure that there are disclosures in the financial statement, right? But how to go about auditing them? Let's find the next perspective. Overload of information. We know that with passage of times and over the years, the annual reports have become very healthy in terms of number of pages. There is loads and loads of information in the annual reports. You find a lot of disclosures in the annual report, and the annual reports have been the annual reports are becoming healthier in terms of pages. You add on pages, you provide more information to shareholders, and this overload of information has increased over time, particularly after corporate governance came in, and the emphasis of the corporate governance on openness of information and transparency of information has led to the information overload. So there is a lot of information in the notes. Now that is a big challenge for the auditor, that as to whether the auditor is looking after every disclosure, every note, because there might be excessive details given in the notes to the financial statements. So we know that the companies have a stance of putting a lot of information, and they believe that putting a lot of information is good for shareholder. Overload of information is good for shareholder, and with the advent of openness, with the advent of transparency, a lot of companies are putting a lot of information in the annual report. But that is also a challenge on the part of the auditor, that how the auditor tackles that overload of information, particularly the overload of information in the notes to the financial statements, which is an integral part of the financial statements. Let's find the challenges for the auditor with reference to the overload of information and more disclosures in the financial statements. If you look at the challenges for the auditor, number one, determining the materiality. Audit is done on a material basis, right? And the auditor needs to find material disclosures. Auditor needs to define what is a material disclosure, because auditor cannot look after every disclosure in the notes, right? So auditor needs to emphasize on material disclosures, significant disclosures, and I'll be emphasizing on that shortly. Number two challenge for the auditor is the source of information. Uh, from where the information is coming from, which helps the management to make a disclosure, because disclosure needs more information, right? So where is the information coming from, and what is the credibility of the information on the basis of which the disclosure has been made by the management? So the source of information which is helping the management to make a disclosure or make a note in the financial statement. And again, I will be emphasizing on that shortly. And the third challenge for the auditor is the timing consideration. At Because we know most of the time we are in panic in the audit. We have less time in the audit. So at what point in time during the audit you will be auditing disclosures? And when do auditor gets disclosures? At the early stage of the audit or at the later stage of the audit? So that is also very important. So let's have an emphasis on three of them, the three challenges: determining the materiality, source of information, and the timing consideration as three very important challenges for the auditor. Number one, materiality. We know auditor needs to exercise judgment in deciding which disclosures to consider during the course of audit, and that exercising of judgment is very important. That will vary from a company to company, that will vary from a listed company to a non-listed company, that will vary from a small company to a large company, that will vary from a new audit client to a recurring client. So auditor needs to exercise a careful judgment which disclosures to audit. Take into account those disclosures that could reasonably be expected to influence the economic decisions of users. Auditor needs to take into account those disclosures which are important for the shareholders, or the auditor believes that the shareholder will be focused on this particular disclosure. So the auditor needs to take into account that disclosure into the materiality perspective. We know normally the auditor takes materiality in context of the shareholder, something which can influence the decision of the users of the financial statement. So once you decide which disclosures to audit, the second important challenge for the auditor is the sources of information. The information which is included in the notes to the financial statements, whether quantitative or qualitative in nature, is derived from the systems and processes that are not part of the journal ledger system. In the journal ledger, we get the accumulative number like total sales, total purchases, or the total expenses. But when the management goes with the disaggregation of the sales, or when the management goes with the disaggregation of the purchases, or when the management goes with the disaggregation of the expenses, or when the management do the segmental analysis, so a lot of information is needed outside the journal ledger. So what sort of systems the management have in place for disaggregating numbers, disaggregating the account balances coming on the face of the balance sheet and the income statement? So the auditor is very much concerned about the credibility of the source itself, and the systems in place. We know the auditor is very concerned about the quality of system, how robust the systems are in the organization, which is producing the financial data. So the journal ledger and the trial balance is one set of data, right? But when we look at the notes to the financial statement, they might be coming from information which is not part of the journal ledger system, or which might be beyond the journal ledger system. So the auditor is a bit concerned about identifying the source and the quality and the credibility of the source from where the information has been derived. So that will boost the credibility of the disclosure made in the financial statement. Examples of disclosures which can be risky for auditor includes the forward-looking statements. A lot of time the management disclose something about their foreseeable future. Now, when the management speaks about their foreseeable future, like a going concern, the information is not coming from the journal ledger system, right? The information is about the future. So when there are forward-looking statements in the financial statement, the risk increases of the credibility of information. Descriptions of models used in fair value measurement. Now we know the fair value measurement is another very important area where the information, the source of information, the credibility of information plays a very important role. Descriptions of risk exposures like under IFRS 7 and IFRS 9, and other narrative disclosures like related party transactions. So there are a lot of disclosures which needs greater information, which needs future informations, which needs informations which are based upon estimates, judgments. So that is the point where the source of information becomes very crucial for the auditor. So when the auditor is auditing the disclosures, first of all, the auditor needs to define the materiality to decide which disclosure to audit and which disclosure not to audit. But then the auditor also needs to decide the source of information, the credibility of information, how trustworthy the disclosures are, how credible the disclosures are, so that the auditor can gather a reasonable assurance on them. The last challenge for the auditor is the timing. Now you need to understand that disclosures are prepared by the management very late in the audit process. Normally we get disclosures towards the end of the audit, the notes to the financial statements. The notes to the financial statement comes very late in the audit process. So that is a big challenge for the auditor. So at what time the auditor would audit them? So when the auditor is planning the audit, draft disclosures are not available. So it is not possible for the auditor to plan the audit of disclosures until much later in the audit process, and that's a challenge. So disclosures are not made available to the auditor upfront. They are made available to the auditor at a late stage of the audit or at a later stage of the audit, and that brings the challenge. So the auditor has to allocate proper time for them, right? So auditor needs to do a very proper planning, needs to make a very proper timetable of putting time towards the end of the audit for auditing disclosures, towards the completion stage of the audit. The auditor needs to emphasize upon whether disclosures have been verified, they have been audited, because they will be made available to the auditor at a very later stage. There is a higher audit risk, right? In that there may not be much time to assess the risk relating to disclosures, because you will be getting them very late. You might be in a panic of winding up the audit. You might be in a panic of completing the audit. And at that point in time, you might lose focus on auditing disclosures. So the auditor needs to consider this challenge and need to allocate proper time and resources in the audit process to mitigate the risk of overlooking material disclosures in the financial statements. The IAASB has given some proposals to the auditor that when you are auditing disclosures and you know there are challenges like defining the materiality, there are challenges like the source of information, there are challenges like the timing factor, how should the auditor be prepared for auditing disclosures? Let's see what are these proposals, and from an examination point of view, these can be used as procedures, or these can be used uh, as something where the examiner asks you about uh, disclosures in the financial statement and actions about disclosure, something like that in the AAA paper, and this might become very important for you. The first proposal: emphasize the importance of giving appropriate attention to and planning adequate time for addressing disclosure. That is what we were discussing shortly, that the auditor needs to make a proper timetable at the stage of planning, needs to allocate proper resources, so that even though the auditor know that the disclosures will be made available at a later stage of the audit, at least the auditor don't come in panic. Auditor has allocated time, resource for disclosures. So the auditor will not come in the panic mode. So you need to have a proper planning, you need to give proper time, you need to give proper attention to disclosures, and that can only be possible if you have done a good planning at the start of the audit and realizing the fact that the disclosures will be made available at a later stage. Number two, emphasize when agreeing the terms of engagement. So when you are making the engagement letter with the management, do emphasize at that point, do emphasize this to the management when you're making the engagement letter, that to make disclosures available as early as possible. So at least try to put an emphasis to the management that we need disclosures. So if you can make them available a bit earlier, would be better. So at least you can bargain the time with management, or you can emphasize on the early availability of disclosures by putting them in the engagement letter and agree that with the management, would be better. Okay, so that's the second action or procedure. Carefully evaluate any misstatements found in disclosures. If you found any misstatements in disclosure, you think the disclosures were incomplete or the disclosures were not adequate, or a certain disclosure was not given, which should have been given as per the accounting standards. So if you found a misstatement in disclosure, carefully evaluate that, carefully evaluate the significance of that, and then discuss that with those charged with governance, so that you can make a correction, or the management or those charged with governance can make a correction. Otherwise, there will be an impact on the audit report of the disclosure found inappropriate, or a disclosure not found in the notes to the financial statement. So these are proposals by IAASB, not very difficult proposals. Have a very proper planning, emphasize the need of getting disclosures early in the terms of engagement, carefully evaluate the misstatements you found in disclosures, and then discuss them with those charged with governance. So you should know these proposals. You should know the challenges the auditor have when auditing the disclosures, like the materiality, like the timings, like the source of information. And you should also know the types of disclosures, the qualitative disclosures and the quantitative disclosures. So I hope this short discussion on this very important topic will make you realize the importance of this topic from an examination point of view, and preparing this topic in a very effective manner for your exams. Have a nice day. Goodbye and Allah Hafiz.